$80 billion. I mean, that is a staggering amount of money, right? And it's exactly the amount of new funding that has completely transformed the IRS from top to bottom. If you're a homeowner over the age of 60, you really need to listen closely to this, because that $80 billion has been used to build a highly automated system that's currently scrutinizing the tax returns of senior homeowners like literally never before. Okay, so let's dive into this, because understanding the contrast here is absolutely critical for managing your risk. For decades, the IRS we all knew, the IRS of the past, was honestly pretty underfunded. They had outdated computers, not enough staff, and audit rates were at historic lows, meaning compliance gaps basically went totally undetected. But the IRS of 2026, it's a fundamentally different machine. That $80 billion went straight into enforcement and tech, creating this automated data-sharing powerhouse driven by machine learning that flags discrepancies automatically.
Now, let me just put on my financial advisor hat for a second, okay? I want to reassure you, the IRS isn't sitting there looking for suspicious behavior, and they certainly aren't judging your personal family decisions. As the saying goes, these are not judgment calls, they're simply mathematical comparisons. You see, millions of older Americans have made completely normal, understandable financial choices involving their homes. The issue is, a computer is now just doing the math behind the scenes to see if the required tax paperwork matches those choices.
So welcome to this explainer. You can think of me as your personal guide today. We're going to navigate these automated and frankly pretty stressful IRS letters together. But most importantly, we are going to get you prepared and protected well before that crucial May 19th deadline. To kind of lower the tension a bit, here's our clear roadmap. We'll look at the automated IRS era, then walk through 4 big unintentional mistakes: home equity, deed transfers, rental income, and inherited property. Then we'll wrap up with your 5-step action plan.
All right, Section 1, the automated IRS era.
We really need to understand exactly where the IRS is actually pulling all this new data from. Back in the day, these data sources were completely isolated, but today, county recorder offices literally have data sharing agreements with the feds. Mortgage servicers report loan balances directly. Title companies, short-term rental platforms, even estate and probate courts, they all feed their data right into one massive centralized IRS matching system. And here's the kicker. This system processes millions of records simultaneously, and it never ever takes a weekend off.
Moving on to mistake 1, home equity.
Now, this is probably the most innocent mistake of all. As everyday costs go up, you might tap into your home's equity. Maybe you use a home equity line of credit, a HELOC, for medical bills, or, to help a grandchild with tuition. That is a totally valid, understandable family decision. But this brilliantly illustrates the hidden tax trap here. Under the 2017 Tax Cuts and Jobs Act, home equity loan interest is only deductible if you use the funds to buy, build, or substantially improve the home. If you use the money for debt consolidation or medical bills, and your preparer claimed it on Schedule A, well, the new IRS system is going to flag that incorrect deduction instantly using the lender data they now have.
Next up, mistake 2, deed transfers.
Adding an adult child to your house deed, it's a super common family decision, right? Usually done with the absolute best of intentions, just to avoid probate or simplify things. But tax-wise, it's not just some simple administrative tweak. It is a legal transfer of real estate, which the IRS treats as a gift. For 2026, the annual gift tax exclusion is $18,000 per recipient. If you transfer a share of your home equity that exceeds that amount, bam, it triggers a Form 79 reporting violation if you don't file. And yes, the IRS is actively catching this by cross-referencing county deed records. Let's look at the actual financial impact here regarding what the IRS calls your basis, which is basically their word for the original cost of your home. Let's walk through this carefully because this is a massive aha moment. When you gift property while you're still alive, the recipient gets a carryover basis. Meaning, if you bought your house for $80,000 30 years ago and gift half to your kid, their basis is just $40,000. But if they inherit that same half at your death, they get a stepped-up basis to the current market value, say $400,000. So by gifting it early, just to be helpful, you might unintentionally stick your kids with tens of thousands of dollars in capital gains taxes when they eventually sell. Crazy, right?
All right, mistake 3, rental income.
Renting out a spare room has become a fantastic way for seniors on fixed incomes to comfortably cover those rising property taxes. It's incredibly appealing. But there is a strict, and I mean very strict, threshold you have to know about.
just $600. The minute you receive more than $600 in gross payments over the year from platforms like Airbnb or VRBO, they are legally required to issue a Form 1099-K. And guess what? That form goes directly to you and the IRS at the exact same time. If you don't report that income properly on Schedule E of your return, the system knows immediately. Actually, it's not even a traditional audit. You just get hit with a notice CP2000, an automated underreporter assessment. The computer just assumes you owe tax on the unreported income plus interest plus an accuracy penalty. And if you ignore this notice for 60 days, that proposed assessment becomes absolutely final. Mistake 4. Inherited property. This is arguably the most emotionally difficult trigger on our list. It happens when folks are navigating the loss of a loved one, and, totally understandably, the inheritance paperwork just falls through the cracks. When you inherit property, you are entitled to that wonderful stepped-up basis we just talked about, but it only works if you actually document it. If you miss filing a Form 706 or don't get a qualified appraisal around the date of death, the IRS takes a shockingly harsh stance. An undocumented basis is treated as a zero basis. So if you sell that inherited property later for, let's say, $300,000, the IRS can assess capital gains tax as if your original cost was zero. That could mean a completely unexpected tax bill of $45,000 to $70,000. No thank you.
Okay, Section 6, your 5-step action plan.
Take a deep breath. I know this all sounds a bit daunting, but we're moving from the problem straight into the solution. I'm here to be your steady guide to beat that looming May 19th deadline. So the crucial point is that you have a roadmap to fix this. And here it is. Step 1, gather all your home documents. Step 2, compare them against your past 3 tax returns to see if anything is off. Step 3, contact a qualified CPA or enrolled agent who actually has real estate penalty experience. Step 4, go access your free tax transcript on irs.gov so you can see exactly what the IRS sees. And step 5, if you get a notice, respond to it immediately. Do not wait. Now, if you need to, go ahead and pause this explainer right now and take some notes on this document checklist. For step 1, you need everything going back to 2022, original purchase stocks, HELOC statements, any title changes, and please dig up your home improvement records. A new roof, a kitchen remodel, those permanent improvements increase your basis, which directly reduces your taxable gains when you sell. Seriously, don't let a missing receipt cost you real money out of your pocket.
And honestly, I cannot stress step 5 enough. You see, an unanswered computer notice doesn't just mysteriously disappear. Look at how aggressively this timeline escalates. Month 1, an unanswered CP2000 notice sits there. By month 3, it escalates to a statutory notice of deficiency. By month 6, it becomes a final assessment and eventually a federal tax lien right on your home. Every single step you ignore makes it exponentially more difficult and way more expensive to resolve. Real quick before we wrap up, I have to deliver a very stern warning. Every single time a high-profile tax issue affects seniors, scammers just come out of the woodwork. You have got to protect yourself. The real IRS initiates contact through USPS mail, period. They do not call you demanding immediate payment over the phone, they do not send urgent emails with sketchy links, and they absolutely never ever demand gift cards or crypto. If you get a phone call trying to panic you, it is a fraud. Just hang up the phone immediately. The window to voluntarily come forward and take advantage of penalty relief really narrows down after May 19th. So I'm going to leave you with this question. Will you take action before May 19th, or are you going to let a computer dictate your financial future? Look, you didn't create this situation intentionally, but informed action is what's going to change your outcome. If this explainer gave you some clarity today, please share it with anyone you know over 60 who owns a home, because honestly, that one simple share could literally save them thousands of dollars.